Okay, so welcome to part 2 of topic 6, financial instruments. And our focus for today will be for hedging accounting and foreign currency swap. Okay, so we have three major contents. One is the concept of hedging, then hedge items and hedge instruments, and foreign currency swap. Hedge accounting is designated or designating one or more hedging instruments so that their change in fair value is an offset to the change in the fair value or cash flows of a hedged item. So in this case, you're actually trying to minimize or reduce the possible risk or you might face when transacting particular transaction. It usually happens for imports and export agreements. The hedge item is the asset, liability, commitment, highly probable transaction, or investment in a foreign operation that exposes an entity to change in fair value or cash flows and is designated as being hedged. So, for example, if you're trying to buy something outside of the country, and as we have discussed in foreign currency in one of the topics before, there are chances that the items or the value of the items might change because of the fluctuation of foreign currency. So what you will do as a business person, you want to minimize the risk or the fluctuation. Hedging instrument is a designated financial instrument whose fair value or related cash flows should offset changes in the fair value or cash flows of a designated hedged item. This is what we can say as the tool to offset any change in foreign currency that might put the company at risk or at financial risk. So just to be sure that they will not suffer a lot, companies will engage in hedging transaction. Criteria in applying hedge accounting. The first one is there are only eligible hedging instruments and eligible hedge items in the relationship. The second one is you have the hedge documentation at the inception of the hedge, in which you designate and describe your hedging. And number three, hedge effectiveness criteria are met. Of course, you want to ensure that you will be reducing the possibility of risk. And you have to know whether the hedge transaction that you entered into will be effective before you apply the hedge accounting. Types of hedges, we have fair value hedge, cash flow hedge, and then hedges of net investments in foreign operations. Fair value hedge used to hedge the value of particular assets or liabilities. So meaning your focus here will be the item that you purchase. But on the cash flow hedge, your focus will be on the future expected cash flow payment. Okay, under fair value hedge, the hedge instrument or the tool to reduce the risk, any change on it will be under fair value to profit or loss. And then hedge item, adjust carrying amount through profit or loss or OCI. Cash flow hedge, the hedge instrument, effective portion to OCI, remaining part to PL. And then you have to reclassify it cash flow hedge reserve in equity. And then hedge on net investment in a foreign operation, that will be treated as cash flow hedge. So whatever you apply on cash flow hedge, it will be applied to the net investment hedge. Now let's try to test the effectiveness of hedging transaction. An entity has a fixed rate loan and has an as interest rate futures contract as a hedge of change in the fair value of the loan from the change in interest rate. So here they're trying to reduce the risk of the varying interest rate. So it's not limited only on foreign currency transaction, but also on loans with varying interest rate. So the interest rate has increased and the value of the loan has increased by 35,000 kina. At the same time, the fair value of the future contract has declined by 30,000 kina. So which means this future contract that they entered into is that will be the hedge item which will help them to reduce the risk of the increased value of the loan. So the test will be, is the hedge effective? So the solution will be change in fair value or cash flows of the hedge item over changes in fair value or cash flow of the hedge instrument. So it should be within 80% to 125%. So in this case, we have change in the fair value or cash flow of the hedge item or the loan and interest 35,000. While the change of the future contract or cash flow for future contract is 30,000 kina. So we have here 116.7%. So this can be accounted for as hedge transaction. So this is how you will test the hedge effectiveness. Foreign currency swap, also known as an FX swap, is an agreement to exchange currency between two foreign parties. The agreement consists of swapping principal and interest payment on a loan made in one currency for principal and interest payments of the loan of equal value in another currency. One party borrows currency from the second party as it simultaneously lends another currency to that party. So here, the foreign currency swap is again similar to hedging. Unlike with the previous illustration that we've shown interest rate, here we're trying to minimize the risk of the fluctuating foreign currency exchange. And that's it for the presentation of Part 2, Financial Instrument Discussion. Thank you.